asset classes, equities, gold, Bitcoin, they're all at near or at record highs, and meaning that investors face psychological barriers to invest in. To discuss alternate ways to invest confidently without overpaying during market highs, Marc Jocum joins us from Global X ETFs. Marc, good to see you again.
Thanks for having me, Andrew.
Yeah, good timing, because I've just mentioned all those asset classes were at or near record highs. So it does spook investors, doesn't it? Naturally, you think, well, hang on, it can't keep going up forever. So naturally think, well, okay, I better take something off the table perhaps.
Definitely right. Or to have cash on the sideline and just leave it there until the market falls. And to your point, you're seeing record highs across all asset classes. So the Australian market briefly touched record all-time highs. The S&P 500 reached 6,000 points not too long ago. Bitcoin trading at all-time highs north of $90,000. And then gold as well. And a lot of people may be a little bit hesitant of investing in all-time highs. And when you look at the chart on your screen, actually, which shows in the orange bar, is if you invest during any day versus if you invest when the market's at an all-time high. Naturally, what happens is markets are pretty favorable when you invest in all-time highs. And to your point, Andrew, you were speaking about Cyber Monday stocks. A lot of people are waiting for stocks to go on a discount. That can be a little bit of a tough strategy to try and execute on, because all-time highs are actually more bullish than they are bearish for markets. So I feel like for a lot of investors who are seeing things a little bit toppy at the moment, it doesn't mean that you shouldn't invest. It doesn't mean that you should necessarily take some profit off the table. There are some strategies, and that's because a lot of people have these, it's called the gambler's fallacy, where you think that past events is going to influence future events. It's like going to the roulette table.
Which is completely irrational, isn't it?
It is. It is irrational. But if you're at the roulette table and you're seeing red, 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 you think, oh, it's due for a black.
Yeah.
And I think that's the problem with investing, is a lot of people are waiting for that downturn. But overall, investing when markets are still at all-time highs has tended to be a proven investment strategy.
Yeah, so you're saying more often it goes up than down.
It does. And that's because all-time highs tend to cluster. And what that means is when you have an all-time high, the subsequent all-time highs tend to happen very soon after. In fact, 90 to 95% of the time of reaching an all-time high, the subsequent all-time high happens within a month. So when you look at the data going back to, I think we looked at data going back to the 1850s, all-time highs have happened around about 67% of days, of trading days, which doesn't sound like a lot, but that happens at least 15, 16 times a year, which is more than once a month. So overall, when you're thinking the markets are at all-time high, it doesn't mean that you shouldn't actually lean away from investing, but maybe you can look at investing strategies that could be a little bit more favorable to the market environment, because markets do look quite expensive at the moment, even though they are at all-time highs. And that's where looking at all these investment strategies, whether you're looking at traditional funds or more so recently, exchange-traded funds have become super popular. That can be a really good avenue to invest during these times.
We'll get to that in just a moment, but you take a look at what's going on in the market. It's very bullish at the moment. Then you had the Trump trade, and then we're getting into the Santa Claus rally. So, seasonally, potentially, it's looking positive. Nonetheless, if you are concerned, what's a good strategy? Dollar cost averaging?
Yeah, so one of the best ways to do it from a psychological perspective, one, have a look at the data, which we shared with your viewers on the screen, but two is around investing regularly. And that's what we get a lot at Global X, is clients asking, is now a good time to invest with markets at all-time high? And the answer to that is you can regularly invest through dollar cost averaging. So investing in regular intervals, smaller amounts, and that way you minimize that psychological regret just in case markets do fall overall.
All right, but you're saying perhaps a good strategy to take, being cautious, is value-orientated investing or growth at a reasonable price.
Yes, so it's a strategy that's becoming a lot more topical nowadays. And I think when you're investing in the share market, you have to ask yourself the question, do I have confidence, or do I view that these companies can continue to grow their earnings and their profitability and their revenues over time? If the answer to that is yes, well then it makes sense to be investing. But you've got the US market trading at about 25, 26 times earnings, the world stock market trading at 23 times earnings, even in Australia trading at 20, 21 times. So that's where applying a growth at a reasonable price strategy. So you're investing in growth companies, but you're employing this value discipline by not overpaying for growth. You can invest in companies that have solid financial strength, strong earnings, but are still trading a little bit cheaper to their intrinsic value. And I mentioned, it's important not to wait for a bargain, and that's why having a bit of a blended strategy can make a lot more sense. And we've recently introduced the Global X S&P World X Australia GARP ETF. The ticker code for that is GARP. It's been a fantastic product so far in terms of the underlying historical performance, outperforming the broader world index year to date. Over the last 20 years, it's returned about 13% per annum, which is a little bit better than the 9% from the broader global universe. And it just makes a lot more sense in this environment where markets do look a little bit expensive, but you don't want to overpay for that growth. So that's where GARP investing strategy can make a lot of sense.
All right, GARP obviously standing for growth at a reasonable price. Where's the exposure? What does it have exposure to? Which companies?
So it's got exposure to a range of different sectors, which is great. But you're looking at companies who have been pretty much the market stalwarts at the moment. So you've got the likes of Nvidia, you've got the likes of Apple. But then what I also like about this ETF is it has exposure to a range of different other sectors. It's not just all about tech, because there's a range of companies that are growing their earnings, growing their revenues, but also trading a little bit cheaply. So Berkshire Hathaway's, so Warren Buffett's Berkshire Hathaway's in the portfolio at the moment. You've got companies like ExxonMobil, you've got companies like Visa, Costco. It is a little bit US centric, about 70% of the portfolio is in the US, but then you still have exposure to other developed markets as well. So for investors looking to blend that strategy, who are a little bit concerned around valuations at the moment, markets are at all-time highs, but that's not a reason to remain uninvested.